Thank you. The gentleman from Arkansas, Mr. Hill, is recognized for 5 minutes.
Thank you, Chair Waters. Again, Chairman, welcome back to the House Financial Services Committee. I want to thank you for your discussion that you had with Dr. Foster a few minutes ago. I, too, want to thank you for your work with Governor Brainerd and our discussion that we had with the governor and the staff about the concept of a digital dollar and the work being done at the Treasury about that. I won't belabor some of the points that Representative Foster made, but a couple of comments that I'd have for you on that. Would you advise our committee or ask the Fed to advise our committee what legal authorities the Federal Reserve might require in order to consider the use of a digital dollar?
Yes, I mean, that's a good question, and it's one we're looking at. A lot of it would depend on the design of that currency.
Exactly. And one thing we also talked about, and we've had a lot of discussions in our FinTech task force here, is about Europe's approach to this idea of a payment provider license, which is now part of their financial services code, part of their open banking movement, and the idea that one would have a regulatory license here in the United States for being a payment provider. It might be a bank or it might be a non-bank. Is that something the Fed's looking at as well?
I wouldn't say we're specifically focused on that, though, but you more broadly, it's, we think, a good idea to look at the whole landscape of oversight of our payment system, and that would be a piece of that. And as you may know, Governor Brainerd talked about that in another of her speeches last week.
Right. Thank you for that. Last month, the Chinese regulators bailed out Hingfang Bank. It was a $14 billion loan that they arranged through one of their sovereign wealth funds. The Chinese banking assets at $41 trillion now are 47% of world GDP. Is instability in Chinese banking industry pose a financial threat to the global financial system? Is it a financial virus, like they've already contributed a physical virus?
You know, generally, as I'm sure you're aware, China has had very high debt to GDP for an economy at its stage of development, and that includes the banking system. And the government has actually, for several years now, been taking measures, led I think by the central bank, to try to control the growth of debt. And they've stuck to that through the last couple of years, even though those were challenging years economically for them. So it's something that they're addressing. The other thing is to say is that they have plenty of fiscal space. If you look at fiscally, they have plenty of power to respond to downturns. So I wouldn't go so far as to say that their debt is a systemic threat to the world economy or anything like that. And it's something that they need to address and are.
I think it's something that I think deserves review. Mr. Barr talked about their misallocation of resources. At 47% of global GDP, that seems like an overallocation in the banking sector in China and could pose a threat to our system. In your report on page 24, you talk at length on your financial stability section about the decline in bond yields, particularly in the high yield market. The ratings have fallen. And I was looking at a mutual fund annual report the other day, and it says, a particular concern is the continuing high rate of issuance of BBB bonds, the lowest category of investment grade rated bonds. If the economy stumbles and rating downgrades issue, it could be a flood of fallen angels. And this particular mutual fund said they're staying away from the lower end of the high yield market. Are you concerned about the high yield market?
Well, that's the so-called BBB cliff, and the idea is that there are a handful of very large issuers, which if they were, downgraded, would then be non-investment grade, and the idea is that some holders are not permitted by the terms of their agreements with their investors to hold non-investment grade, and that might trigger sales. So that's an issue we've been monitoring for some time now, really. With leverage lending more generally, yes, we're monitoring it very carefully. You do see, low compensation for risk taken. You see high leverage. You see a lack of covenants. You see all of that. I think it's a complicated picture, though. That paper is now largely held in CLOs and not on mutual funds and exchange-traded funds, rather than on bank balance sheets. So, and those vehicles tend to be stably funded in the sense that their liabilities are actually longer than
Yeah.
the expected maturity of the underlying instruments that are
It's
helping.
still a source, I think, of financial concern to the FSOC, I would think.
It is.
You know, and therefore I commend you for noting it in the report, and thank you for your continued attention to it. Yield back.
Thanks.
The gentleman from Illinois, Mr. Caston, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Chairman Powell. I appreciate you sticking around all the way to the bottom of the dais here. If I get elected 8 more times, fingers crossed, I'll have as much experience in this line of work as I do in the energy sector. So I still come here primarily as an energy nerd, and I have a real concern that we are not dealing with the realities of climate change scientifically. We understand viscerally what it means to have rising sea levels, but we haven't really thought about what it means to have an accelerating rate of change. Compound interest confuses people, and compound changes in the environment, we don't even really think about it as well as we should. Just a couple data points that I hope all of us can appreciate. The first evidence that hominids made fire is a cave 1 million years old. James Watt invented the steam engine 244 years ago and ushered in the Industrial Revolution, and 50% of all the CO2 we have ever emitted as a species is since Back to the Future came out in 1985. This is this massively accelerating shift, and if we went to 0 CO2 tomorrow, we're looking at 2 feet of sea level rise coming. The more realistic trends we're on is at least 6 feet of sea level rise coming, and at that level, there's estimated about $23 trillion of economic loss to the system, $900 billion of U.S. property at risk before factoring in debt losses and pulling out of insurance. And there are some serious systemic risks to the economy if we leave those unaddressed. And I just want to understand a little bit how you and the Fed are thinking about those risks. Number one, given that the assets exposed to climate change exceed the entire subprime mortgage market prior to the global financial crisis, how, if at all, is the Fed thinking about climate change as a systemic risk to the economy?
So climate change, again, a very important issue, one that is really the province of elected representatives to set the overall direction of society in how we will respond to climate change and its challenges. Nonetheless, we have a job to do, and that is to think about the potential implications for the financial system, for the economy. And I think we're at the very early stages of filling in what exactly that means. In terms of things like particular assets, these are longer-term considerations. We're essentially mainly concerned with business cycle issues. That's what we're focused on, is issues for the medium term. Climate change is a much longer cycle kind of a thing.
If I may, a part of the concern I have is that the actors in the space do not have planning horizons that match to the reality that you and we do, right? There's people signing 30-year mortgages right now for properties in Miami Beach, and they may plan on reselling that mortgage a number of times, but somebody's going to be left holding the paper with that sea level rise coming. The insurance industry typically has 1-year holding period. So, and even if the U.S. is successful at reducing carbon emissions, there still is a massive reallocation of capital. Have you looked at the transitional risks in thinking about how that starts moving around and dislocating the economy?
So those are the things that we're at the beginning stages of looking into. As you obviously know, there's a lot going on in the financial markets. There's a lot of disclosure happening, and expectations around disclosure are changing significantly for publicly held companies, and that will have an effect. But that's not really what we do. We do monetary policy, bank supervision. Well, our banks, to your point, our banks have to be taking into account the risk of severe weather events and potentially, I suppose, of rising.
Well, let me maybe give a specific one that's been bugging me lately. If you look at the fossil fuel industry, the oil and gas companies, the coal companies, the debt that they hold relative to their assets, given as their assets are so heavily dominated by fossil fuel reserves, if they were to extract all their fossil fuel reserves, things are going to be way worse than the $23 trillion I just told you. Have you ever considered stress testing to see whether their failure to fully monetize their reserves might effectively make them fiscally insolvent? Because if that to me sounds like a materially adverse event, but I wouldn't want to bet that the economy is going to commit suicide. But if I look at the financial statements of a lot of those companies, it's not clear to me that they can monetize those assets. That has a meaningful effect on the risk of money that's held today. I think there was $700 billion lended to fossil fuel companies in the last couple of years. Have you considered that as a systemic risk?
Well, for us, it's systemic risk to the financial system, and we'd be stress testing banks. As you know, the Bank of England is doing some of that now, and we're going to be watching and see what they learn, and maybe that's a path we'll follow.
Thank
We haven't
you.
made that decision.
Thank you. I'll follow up with you offline. I yield back my time. Thank you, Chairman.
Gentleman from Georgia, Mr. Loudermilk, is recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, thank you again for being here. First of all, I kind of want to touch back on LISIC. I know that some have already touched on this subject, and as you know, several weeks ago, Vice Chairman Quarles gave a speech where he outlined a number of changes that he would like to make to the Fed supervisory and regulatory process. He said he intends to bring transparency to the LISIC regulatory regime by developing clear and transparent standards for designating firms. He also proposed aligning LISIC designation with the Fed's tailoring categories and limiting it to only Category 1 firms. So my question is, at a press conference after last month's Federal Open Market Committee meeting, you said you generally agree with Vice Chairman Quarles and what he had articulated. Appreciate that, but can you give us an idea of when you expect LISIC designation to be confirmed with new tailoring rules?
I don't actually have a sense of where that is in terms of the timing of it. You know, at any given time, we have a bunch of things in train to do, and that's certainly one of them.
Okay. Hopefully sooner rather than later.
I don't want to commit to something that, you know, there are a lot of things we're working on at all times, but that, you know, Vice Chair gave a speech about it. I'm aligned with that, and I expect we'll be moving forward.
Well, that's very good to hear. Real quickly, I'd like to touch on the CRA. I believe that all three banking agencies need to have a unified CRA framework, and I know you're hesitant to speak on behalf of the other agencies, specifically OCC and FDIC and their proposals. If you don't want to comment on that and understand that, what are some of your ideas or the Fed's ideas for CRA modernization?
So I would say, let me talk about the process. You know, we kind of agree on the overall goals, and the question is, how do you get after that? And so our thinking was to try to get to a set of improvements, really, that would lead to more efficient, more effective CRA. So we're looking at ways to make the assessment, the tests clearer. In our thinking, there's a separate at the retail level, there's a separate test for community development and for retail lending. Also that the other thing we're saying is let's make sure that it's all very grounded in data. So we've got, as the chair mentioned earlier, 6,000 data sets that we look at. So I think we really know when you make a change in the metrics, we kind of know what the effects are going to be, and we feel good about that. So we tried to develop our proposal around that. There are a lot of overlaps, but there are a handful of differences that have prevented us to get to full agreement.
In the overall objective, do you believe that we can remove some of the ambiguity on what projects do and do not qualify?
Absolutely. I mean, transparency ex ante, more transparency ex ante as to what qualifies and where, more objectivity. All of that, it should help to, encourage banks to do more if they really know what's going to qualify and what's not. And I think that's all very constructive. It's really about how you implement it, and we want to have a very high. It's a very important law, very, very important law. We want to have a high level of confidence that what we change is going to have the desired effects, and that's what we're focused on.
Well, I appreciate that, because I would like to see us make changes to where it's not financial institutions just checking boxes to get credit, but actually investing in projects that do help revitalize these communities. So, as you know, the fiscal year 2020 appropriation law directs Treasury Department in consultation with the banking agencies to study whether any changes in banks' regulatory capital requirements are needed because of CECL. If the study concludes that is the case, are you open to modifying regulatory capital requirements accordingly?
Well, yes, I think we've said that with CECL, we're going to be monitoring very carefully what the implementation is showing because of some of the concerns that have been raised.
Okay. Thank you. And I probably don't have time to get into any other questions. So with that, I yield back the balance of my time.
Thank you. The gentlewoman from California, Ms. Porter, is recognized for 5 minutes.
Thank you. Chairman Powell, you've frequently spoken about your belief in the importance of maintaining the independence of the Federal Reserve. Do you still have that belief?
I do.
Anything changed in the new year?
No.
Right. Because we don't want the Fed to be making decisions about things like where to set interest rates based on any factors other than the best interest of the country. And I know you've had some experience with the president publicly and aggressively attempting to lean on you to lower interest rates, and I appreciate your continually affirming the importance of the independence of the Fed. But it's not just our president, but there are a lot of people out there who would love the opportunity to weigh in on Fed decisions. Outside of administration officials, what other kinds of people might want to influence you in regard to the Fed's decision-making?
What other people might want to influence us? Potentially quite a wide range of people, I would think. Major
investors, financiers?
I don't know that people are really seeking to, you say might want to influence this. I don't, the answer is I really don't know the answer to that.
Okay.
Many people follow what we do and respect what we do. I think people often, when I meet them, really shy away from giving advice.
Okay.
They really do. They feel like they don't presume to give advice.
So you don't feel unduly pressured by political or special interests?
No, I really
Right.
don't.
Would you say that someone like Jeff Bezos, the CEO of Amazon, one of the richest men in the world, could benefit from having influence over the Fed's decisions?
I wouldn't know, actually. I don't know.
What about Jared and Ivanka Trump? They're very wealthy people. Do they have savings and make different amounts of money depending on what the Fed does with interest rates?
Yes.
What about Kellyanne Conway? Does she, in her role as advisor to the president, and the president's expressed these public views, does she potentially have an interest in amplifying the president's message? That is, after all, her job.
I suppose, yeah. I
Okay.
don't know.
Mr. Powell, I'm going to project a picture up here so that the audience can see, but I'm also going to hold it up for you. Is this you, Mr. Powell?
That is.
Where are you?
That's a party after the alfalfa dinner, an after party that I went to.
Where was that party held?
It was at Jeff Bezos' home.
At Jeff Bezos' home. And when was it taken?
Excuse me?
When was this picture taken?
Saturday night after the alfalfa dinner.
Give or take, you'll stipulate end of January 2020?
Yes.
Recently. Can you imagine how attending a lavish party at Jeff Bezos' $23 million home, along with Jared and Ivanka and the CEO of JP Morgan Chase, Jamie Dimon, might give off the sense to the public that you are not, in fact, immune from external pressures?
I would certainly hope not.
What did you talk about at that party with them?
I didn't talk to any of the people you named.
You didn't talk to anybody?
I didn't talk to any of the people you named.
Oh, can you tell me who you did talk to?
I mainly escorted my son and his brand new wife in there, and I actually introduced them to General Mattis.
Okay, great. I would just suggest that this attendance at this kind of event with these kinds of people is inconsistent with what I would otherwise commend you on for doing a very good job, I think, of reaffirming to the public. This plants in the public's mind, I think, a seed that is counter to what you have been doing. Quickly, Mr. Powell, if you can just name a couple of the biggest drivers of economic growth in this country since the recession in the 1970s. What's been making our economy grow? What factors?
What factors have been making it grow? Well, the hard work of the American people. I think what you've seen is tremendous growth in some sectors and less in other sectors. Of course, the big technology companies, they weren't around 40 years ago. So I think we've seen lots of growth in some areas. I think other areas, much less so.
Mr. Powell, would it surprise you if I told you that women in the workforce are actually a bigger driver of economic growth than technology companies? And in a span of 4 decades since the 1970s, 38 million women joined the workforce, and without those women, our economy would be 25% smaller. So when we talk about the health of our economy and we talk about GDP growth, what I don't hear a lot about, and I'd like to hear more from you about, is about the economic effect of things like childcare availability. In those same 4 decades in which women grew the economy 25%, the cost of childcare shot up 2,000%. Do you know, Mr. Powell, how much childcare in America costs today?
How much it costs today in America? It costs a lot.
Could you put a little bit firmer? You're an economic expert. Could you put a little firmer number on that?
I don't. My kids are grown up.
Thank you. I'll yield back.
The gentleman from Ohio, Mr. Davidson, is recognized for 5 minutes.
Thank you, Madam Chairwoman. Chairman Powell, thank you so much for your time here today. Thanks for the good work you and so many of your colleagues are doing at the Federal Reserve. Just to address comments that came from my colleague recently, is it unprecedented for the chairman of the Federal Reserve to attend a party or reception?
No.
I mean, it's certainly not the first time that a Fed chair has attended a party. I'm certain it's not the first time a member of Congress has attended a reception or party. And so I don't know that we want to say, hey, just because you're at an event, somehow this is nefarious. I mean, heck, you might have actually talked to a Russian on a subway or something. So, the way that these things are linked for political motives is embarrassingly partisan and bad, and I just thank you for resisting all those pressures. Many of them are public, of course, but one that I'm concerned about right now is the repo market. Back home, a lot of people don't know that there is such a thing as repo, but it is a big factor for our economy, and I think some of the warning signs in it have given, rise to the Fed in kind of a blend between regulatory action and monetary policy to inject a lot of cash into that market. Chairman Quarles, spoke recently about the need for that to continue for some time. Can you explain the process about how the Fed is going about reviewing the factors that are contributing to this repo spike and what you've learned from the review?
Sure. So what happened is, as you know, in early September, there was a spike in repo rates, and the federal funds rate moved slightly outside of our band, our target range, for a day or so. And so we didn't see that coming. Market participants didn't either. And so we've been asking since, why is that? One clear reason is that the level of reserves, which is cash on deposit at reserve banks, needs to be higher than we had thought. And so we've in that stream, we have immediately set forth a plan and executed it, and it's worked fine to create that.
So I mean, some have called this quantitative easing. I know you've objected, but essentially we're artificially interjecting cash to produce an outcome that the market isn't producing of its own accord. So I think it's odd that our action is to inject cash from the Federal Reserve to grow the balance sheet at the Fed instead of looking at the underlying regulatory things. What have we talked about? What has the board talked about in terms of regulatory factors that instead of injecting cash to fix a problem, treating the root cause of the problem and changing the regulatory framework?
Well, we're doing both things. The reason we're injecting the cash is to supply the demand for cash for basically banks that need to have a certain amount of cash for liquidity purposes. Turning to the second issue, though, we also said that without undermining safety and soundness, we would look at ways in which regulation and supervision might have interfered with the otherwise free flow of cash to where it was needed. And I think we've done a lot of work on that. Vice Chair Quarles hit on a broad theme there, which I think is important, and that is the idea of making the treatment, the supervisory treatment, really, of cash the same as that of treasuries for this purpose. So you could achieve a better flow of liquidity through the system without affecting the overall level of liquidity in the system, which is just what we're looking for. So he broached some ideas for how to do that, and I think that's a very profitable line of inquiry.
Okay, so thank you for that. One of the changes in, as LIBOR is going away and market forces are coming, we're talking about replacing the benchmark rate. And of course, ARC includes 250 entities, but there's a concern that as you've done this, that the best rate isn't necessarily being provided. So is the Fed taking the best proposed rate offered in these repo deals, or are we giving it out at a special rate to maybe the top 10 so far banks?
I'm sorry, I lost track of that.
So when this liquidity is injected,
I see. The repo rate that we're
the
on.
repo rate going into the repo rate, and I guess
No, it's been a couple of, okay, I'm sorry, I missed that. So the rate we've been offering on those, on the repos, that they've been settling at a level that's a couple of basis points below IOER, but that won't be a persistent issue.
but are they settling at a rate that is, when it's paid out at the high rate, is it paid to the best available offer, or is it paid to the best available customer?
We don't distinguish. I mean, anybody who's eligible can bid, and we don't, as long as you're eligible, we'll sell to the.
Thank you. My time's expired.
Would the gentleman like to ask the witness to provide more answer in writing for the record?
I appreciate the chair's suggestion. I would love to see a written answer for how that is actually working.
The witness is requested to provide an answer in writing for the record.
Thank you, Chairman.
The gentlewoman from North Carolina, Ms. Adams, is recognized for 5 minutes.
Thank you, Chairwoman Waters, for convening the hearing today, and Chairman Powell, thank you for your testimony. The FDIC board member, Martin Gruberg, voted against Comptroller Otting's proposal and describing it as a deeply misconceived proposal that would fundamentally undermine and weaken the Community Reinvestment Act. So can you comment on the deficiencies of Comptroller Otting's misguided attempt to gut the CRA, an essential piece of civil rights and banking law?
So I guess I feel like our role is not to be commenting on the other agency's proposal. The public is doing that now. We very much look forward to seeing the comments that they do make. I can talk about how, our own thinking about this, but it's not really for us to be publicly commenting on the other agency's proposal.
So will the Federal Reserve release its own proposal on the Community Reinvestment Act, one that takes into account the needs of low and moderate income communities?
So that of course was why we undertook this work, was to do that. We actually haven't made a decision yet about whether or when to make a proposal, but nonetheless, the whole effort was undertaken with a view to creating a modernization proposal for CRA.
Okay, as you know, the Federal Reserve has a dual mandate, price stability and maximum employment. So will the Fed set a goal for wage growth, and are you considering this approach as part of the framework review?
I don't see us targeting wage growth as an independent item. It's something we monitor very carefully. Our goal, as assigned by Congress, is maximum employment and stable prices. Those are our two statutory objectives, and those are the things that we target. I don't see us targeting a particular level of wage growth.
Okay. So have you considered adopting a floor for wage growth? For example, once we set a certain percentage increase in pay and wages, the Fed may consider switching to 2% inflation rate.
Well, we've said that the sense of this project is we want to make the 2% symmetric inflation goal more credible. And we've been missing it, and central banks around the world have been missing their objectives for a decade now on the low side. And we want to resoundingly achieve 2% inflation. That's really the objective of this review that we've undertaken.
Okay, let me ask a question about the Volcker Rule. Why has the Fed decided to support further changes to the Volcker Rule, given that banks enjoy certain benefits, including access to the Fed discount window, and that the rule was intended to limit banks from engaging in risky investment activities that could contribute to a future financial crisis?
So we did just put out a proposal on part of the Volcker Rule, and of course we think that that proposal is entirely consistent with both the letter and the spirit of the law. And but we're going to be reading the comments. It's out for comment now. We just put it out, and we'll be looking forward to reviewing those comments.
Okay. I understand that you collect a large number of daily trading metrics from banks subject to the Volcker Rule, yet it's never been made clear exactly how these metrics are used to determine whether a bank is complying with the rule nor have any of the metrics been released to the public. Is that true?
I think it's true that so we published the first VOCA rule, I want to say 6 or 7 years ago, and I think very widely regulators and financial institutions found it to be a bit unworkable, and so we set out to provide a simpler set of metrics and ways that companies could conduct perfectly legal activity and have more certainty that they were doing so without having to prove every single trade what was in the mind and the heart of every trader. So because there is going to be trading activity around legal activities that were not covered by the VOCA rule. So I think that's what we're doing. We're trying to make that rule more effective and efficient, but we're doing it in a way that's consistent with the letter and the spirit of the law.
Okay, thank you, Madam Chair. I'll yield back.
The gentleman from North Carolina, Mr. Budd, is recognized for 5 minutes.
Thank you, Madam Chair. Chairman Powell, again, welcome. I want to start by thanking you and Governor Quarles and your federal staff in charge of insurance regulation for your collaborative work with the U.S. State Insurance Commissioners on solvency regulation. Also wanted to thank you for the pushback against the European efforts to try and force their system of insurance regulation onto our unique and sound 50-state insurance regulatory regime. Notwithstanding the progress achieved to date, many in the industry are telling me that the Europeans are still resistant and they ultimately seek to change our regulations so that they mirror theirs. So given that, here's my question, will you commit to directly reaching out to your peers in Europe to tell them explicitly that the U.S. will not be adopting a European-centric ICS or international capital standard, and that we have our own rules that work very well?
So I'll just say clearly that we have a state-based insurance regulatory system, and we have, the federal role is what it is, and that's it's not something we're seeking to change, and we're committed to that going forward.
Chairman, they're seeking to change us, and so I fear that if we're passive, that it will migrate towards them. But have you had any conversations with any senior European leaders yet on the ICS, International Capital Standard?
No, I haven't.
Okay. Is there any reason why not, or has that been something that's been avoided?
No, I just am not. I'm not involved directly in the insurance. There are senior people who are. I'm sure Vice Chair Quarles is.
I would encourage you, again, Governor Quarles, to continue to press that. We have a great system that continues to work well. So also, Mr. Chairman, as part of the Basel III finalization efforts, a number of changes to the capital rules will have the effect of raising capital requirements on capital market activities. So can you discuss your views on the appropriate level of capital markets related activities such as market making or underwriting?
Sure, those are critical activities in the functioning of our financial markets and our economy, and they do need to be appropriately capitalized. I would say that overall, I think, that the level of capital in our banking system is about right, and I don't see a need to further raise capital. So I know we're pushing forward with the fundamental review of the trading book and the other Basel III endgame things, but I don't see them as needed to raise overall levels of capital.
Chairman, can you share how your views on capital requirements and things like market making and underwriting, how they could affect the balance between bank-driven and market-driven finance in the U.S. system?
Well, I mean, I think to the extent you raise capital requirements and they become quite binding, they encourage activity to move outside of the banking system into less regulated and supervised entities.
Very good. So, Mr. Chairman, there's been a lot of discussion in recent months about leveraged loans and FSOC and others monitoring the market. In fact, you've had a couple of questions on this topic today, but when people discuss the issue, sometimes I think they're referencing different things. So to help us get on the same page here, in your opinion, how would you define leveraged loans?
Yeah, you're right. There are a lot of different ways to think about it.
Right.
But, a reasonable ballpark would be something that's rated below BBB. Or you could also say an amount of leverage. Typically, they'll have leverage of maybe 6 times cash flow, EBITDA. You know, there are different ways to think about it, but I mean, I think that the best way to think about it is probably non-investment grade.
Do you think there's a difference in leverage loans in the banking sector and in the non-banking sector?
Yes, I mean, I think before the crisis, I think there's been a trend over time for leverage loans to be held by longer-term holders outside the banking system, and that has accelerated. So there are far fewer of them are on the books of you know, banks with deposit insurance and the safety net, as opposed to collateralized loan obligations or exchange-traded funds or mutual funds or pension funds or hedge funds. That's where those loans are going now. So it's more like it's become a distribution business as opposed to a traditional lending business where banks would make a loan, they put it on the balance sheet. That's not what's really happening. You have a bank performing an origination function on behalf of a sophisticated investor that's stably funded, we hope, and in the case of the CLOs is, but that's something we need to keep monitoring.
Thank you, Chairman.
Thank you. The gentleman from Illinois, Mr. Garcia, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you for being here. Chairman, I'd like to return to the topic of climate change for a bit. Extreme weather events have had a great impact on the Midwest and working class communities like those in my Chicago district, and they're often the hardest hit during such disruptions. Climate change is also a risk to the financial sector. Jim Cramer, host of Mad Money on CNBC, in a discussion last week said major institutional investors want nothing to do with fossil fuels because of concerns about climate change. To guard against climate change impacts, the Bank of England has decided to stress test the UK's capital banks, largest banks, and insurance companies against the risks associated with climate change. Will the Federal Reserve follow suit and develop climate-related stress tests?
So we're monitoring what the Bank of England is doing, and those are, by the way, those are stress tests that are not like our stress tests in the sense that they would have direct effects on the bank's ability to make distributions and things like that. They're really trying to make an assessment, and so we'll be watching that carefully. Okay. We haven't made a decision to proceed with something like that.
Good, I'm encouraged. Looking ahead, incorporating climate change into economic forecasts will become more important. Climate disasters such as Hurricane Maria in Puerto Rico or the wildfires that swept through California last year are currently labeled transitory risks by the Federal Reserve. But we know extreme weather events will become more frequent and severe. The likely result, a corresponding increase in economic losses and physical risks, the brunt of which to be felt by communities of color and working class communities. So, Chairman, when the Fed develops its economic forecasts, at what point should climate change shift from being considered a transitory factor to a structural factor?
You know, our forecasts, both the individual ones that FOMC people like me write down and the staff forecast, they're not for the sort of much longer term. They're really what's important is the next year, the next 2 years, the next 3 years. And climate change just operates on a longer cycle than that. Of course, as you suggest, as severe weather becomes more common, and that's connected to climate change, you will see those things, you know, entering the forecast period and it's certainly entering our supervisory practices as well as our economic forecasting.
Okay. In a recent speech at the San Francisco Fed's Conference on the Economics of Climate Change, Fed Governor Lael Brainerd said, quote, "By participating more actively in climate-related research and practice, the Federal Reserve can be more effective in supporting a strong economy and a stable financial system." Do you agree with Governor Brainerd's statement? If yes, what more will the Fed do in the future to identify and mitigate the financial risks of climate change?
So I do think it's incumbent on us to do the research and understand the implications of climate change for our supervisory roles and our roles in looking after financial stability. And that's what we're doing. I think it's early days for that, but the public will expect that we do that and that we take the measures that we need to take to make sure that the financial system is resilient.
Do you agree with her statement generally?
That statement I do, yes.
Okay, thank you. Big bank mergers and market concentration. 3 months ago, the Federal Reserve approved a merger between BB&T and SunTrust, which created the 6th largest bank in the U.S. with more than $450 billion in total assets. And the Federal Reserve's own research suggests that the failure of a single $250 billion bank would be far worse for the economy than the failure of 5 separate $50 billion banks. Furthermore, the former FDIC chair, Mr. Gruenberg, has warned that the FDIC would not be able to wind down a bank the size of the combined BB&T SunTrust without imposing significant losses on the deposit insurance fund and potentially destabilizing the financial system. In this light, can the Federal Reserve justify its conclusion that, quote, this transaction would not appear to result in meaningfully greater or more concentrated risk to the stability of the financial system?
Yes, I think we can, and I think we did. We evaluate these mergers under a very clear statutory framework, very transparently. We had a number of public hearings on it and looked at all the statutory factors. And essentially, you have two banks coming together to form a regional bank that's akin to or smaller than many of the other regional banks, and it doesn't appear to me to have significant financial stability implications at all.
Thank you, Chairman. I'll yield back, Madam Chair.
The gentleman from Tennessee, Mr. Kustoff, is recognized for 5 minutes.
Thank you, Madam Chair, and thank you, Mr. Chairman, for appearing today. I heard your statements in your opening remarks about the coronavirus, and certainly in regards to some of the questions that you've had today. I noticed this morning in a report that Axios listed, they quoted from the Global Port Tracker, and it said that traffic at U.S. ports is expected to decline in February almost 13%, and in March between 9 and 10% year over year. Now, assuming that those numbers are true and correct, what impact, if any, would that have on the retail sector, and what impact, if any, would that have on the overall economy?
So I think there's a lot of uncertainty around what the ultimate economic effects will be outside of China and particularly in the United States. And the question will be, we do expect that, consistent with that report, that there would be some effects. The question really will be, what will be the size and scope of them, and also, will they be persistent, or will it be something that just passes through? And ultimately, the bottom line question for us is, does it represent a material change in the outlook, something that we should react to with monetary policy? That's really the question for us, and it's really too early to say. We'll be monitoring it like everyone else will, very carefully, and that's where we are.
Along those same lines, and I'm also from Axios, they quoted from a Bank of America security report. They said they surveyed 3,000 companies about the global supply chain, and that many companies around the world are looking at relocating. They called it in the report a quote-unquote tectonic shift in global supply, looking to other areas of South Asia, India, also North America. My question to you, first of all, I don't know whether you're familiar with the study, this Bank of America Securities study or report or not. Are those numbers, or is that those anecdotal statements, is it consistent with anything that the Federal Reserve is seeing?
I'm not familiar with that report and therefore can't comment on it. I would say there are a number of channels through which this could have an effect, the first of which is just tourism, really. The second is that our ability to export to China is less because it's just less going on there. So exports could go down. You mentioned really supply chain. So many U.S. companies buy intermediate goods as part of creating their final product. So supply chain issues, we don't have any real evidence on that yet. And I'd say the last channel is really financial markets, which financial markets themselves can be a channel for the transmission of risk-off behavior, which can affect economic behavior. So we'll be looking at all of that. It's way too early to say what it will amount to. we're just going to have to wait and see. There's no way to be kind of confident about anyone's assessment, and there are a range of assessments.
Based on what you just said, I think I know your answer, but I'll ask it anyway. The report it mentioned a number of reasons. One is the tariffs between our country and China and the impact that it's had on China and subsidiary companies, but also automation and the increase in automation. Does that sound consistent with relocating these supply chains?
Well, that's, yes, separate from the questions about the virus, there clearly has been, on the part of American companies, a lot of activity in moving to other jurisdictions, like Vietnam in particular gets mentioned quite a bit. I saw a report last week. A number of other countries have had American businesses moving their production activities out of China to other locations, and that certainly has happened.
Including the United States?
Yes.
Thank you. Or relocating back to the United States. I guess along those same lines, I represent part of Memphis and West Tennessee. In Memphis, just outside my district, there was an announcement Amazon made 2 or 3 weeks ago that they are locating a new facility there. It'll be 1,000 jobs, and incidentally, you had questions on the minimum wage. They're going to start their wages at least $15 an hour plus benefits. But it talked about these new jobs in combination with automation in terms of packing and shipping. You've talked about your concerns of automation and the effect that will have on employment in the future. Can you see the two coexisting, for instance, like with this Amazon plant?
Well, over the last 2.5 centuries, we've seen advancing technology, and there's been a concern that it would replace human labor, and that has happened. But what has happened, though, is it has made human labor over time more productive. So there's displacement of current workers, but over time, advancing technology has led to rising incomes. But that doesn't mean there won't be disruptions and a lot of pain for people in the short term. But nonetheless, the process over time has led to rising incomes.
The gentleman from Florida, Mr. Lawson, is recognized for 5 minutes.
Thank you, Madam Chair. And Mr. Chairman, welcome to the committee. And I would like for you to explain to me, for the past almost 3 hours, 2 hours and maybe 45 minutes, when you were talking and members on the committee was speaking in terms of how well the economy is doing, you know, how we have more opportunity for jobs in the economy. When you start speaking, the Dow was up 125 points. And while you were speaking, it went down. Can you contribute to tell me why something like this occurs? Who is listening to your speech this morning in front of the Financial Service Committee that will cause the Dow to go down? Is this because of the cuts in interest rate? How do you explain that?
I really can't. I'm not following the market as I sit here answering your questions.
Okay, well, I know the president tweeted out something similar, that when you started off, the Dow was up and then the Dow went down. Do you react to that, or it doesn't really mean that much to you?
I'm sorry, do I?
Yeah, do you react to that, or the president tweet about how the Dow went down in the cutting of interest rates? Do you react to that, or it's just something that happens?
You know, my colleagues and I are completely focused on using our tools to support the American people, to support the achievement of our goals, and that's really all we're focused on.
All right, explain to me too, from the staff report, they stated that starting in July of last year, that for about 3 different times, the interest rate was cut by 0.25%. You know, how do you make decision? Did that stimulate the economy when you made those all the way through October, a 0.25% cut in the interest rate?
Yeah, so we were really looking at a few things when we did that. Yes, the intention was definitely to support the economy. Part of it was to offset the effects of global factors, and there I would say just the slowdown in growth in the global economy just went on, and we felt the need to offset that and also take out some insurance against the effect that might have on the U.S. Trade policy uncertainty was weighing on the U.S. economy. We tried to offset any potential effects and take out some insurance there. And the third reason was that we wanted to do what we could to guard against a more prolonged shortfall of inflation from our symmetric 2% objective. So we've supported growth to support inflation moving back up. So those were the reasons why we did those three things. And that's the thinking that we had and that we announced.
Okay. Now, could there be, I'd like for you to comment, that be a correlation between the growing student debt crisis and slowdown of the housing market, which we talked about a great deal in the last couple of months? As you know, many borrowers of student loans are not able to get homes because of the high debt to income ratio. Could there be a signal that there is a great need to address first the mounting student debt crisis?
So I would say that the rising student debt is certainly a concern. It's been rising fast and is now large. There's increasing evidence that shows that students who can't pay that, who can't service that debt, have difficulty having normal economic lives and buying homes and things like that. I haven't seen any evidence that would suggest that it's an important factor currently today driving the housing industry. I would say the housing industry has actually activity in housing has been moving up here over the course of the last 7-8 months as the effect of lower rates and just overall good labor market and things like that are showing up in more house building and also housing sales.
My time is about to expire. I have a lot of students in my district, in the 5th Congressional District, and many of them coming out of school. One of the things they're concerned about is the housing issue. You know, with going into the job market, you know, how can they best share an American dream like their parents without getting the help from their parents? And so with that, Madam Chair, I yield back.
Thank you. The chair wishes to remind members that we have a hard stop at 1 p.m. today. The gentlewoman from Massachusetts will be the final member to ask questions today. With that, the gentleman from Indiana, Mr. Hollingsworth, is recognized for 5 minutes.
Well, I appreciate the time, and I, both in private and in public, have been extremely complimentary of the work that you and your colleagues have done, not only in calibrating conditions to match the current economy, but also in the framework by which you make many of your decisions and how you present that in public. I can really appreciate, and I know a cornerstone of what you've been trying to do at the Fed is bring even more transparency to the Fed, and some of the decision-making and the press conferences that you've had have added a lot of transparency to it. So it's hard for me to understand some of the challenges in CCAR and the stress capital buffers and some of the more vague language or inability to pin down timeline for changes to that, expectation of changes to that, especially when 2020 CCAR has already started. I know Ms. Wagner also asked about this. I had asked Quarles about this in December. I think I sent a letter to you and Quarles signed by every member on this side of the aisle on financial services, just trying to get a feel for what are the changes that are going to be made, what's the timeline for those that would undertake these stress tests, getting those changes. They're trying to make decisions with trillion-dollar balance sheets, multi-billion-dollar balance sheets, trying to make their plans. This time is now upon us, and I feel like we're still being very vague about what's coming down the pike and when we can expect, even whatever that may be that's coming down the pike, when we could expect that to arrive before us. And so I wondered if you might give some more color on that or give some reasons why you and your colleagues have been a little more hesitant to answer that.
You know, I can't give more clarity than exists, so I'll just say again, we do expect that the core of the stress capital buffer will be incorporated into the stress test this year, and we'll do that in a way that's timely for CCAR.
Okay. In our previous conversations, I think we'd had just kind of a general agreement, and don't let me overstate that if that's incorrect, that some of the aspects of this need to be calibrated, right? We put a lot of this into place post-Dodd-Frank. We felt like we were doing the right thing in doing so, but perhaps we, either had unintended effects, maybe the intended effects weren't as great as we thought they would be, or maybe perhaps this wasn't the area we needed to focus on. And I think we'd agreed that some of this requires significant calibration going forward. And do you expect that there will be further review and calibration of these tests to reflect either current conditions or alternatively what we've learned since the crisis about what works and what doesn't work and what may be adding to significant reserves at many of these institutions?
So my strong view is that that capital, the levels of capital, particularly in the largest institutions, are about right.
Yeah.
And there's not a need to raise or to lower them.
Yeah.
And
Can
the
you tell
stress
us,
test should reflect that.
just out of curiosity, tell me when you say about right, buttress that with data. Help me understand kind of what do you look at to say this means about right, right?
Well, capital levels are much higher, and the quality of our capital is much higher.
Right. Well, that's not undoubtedly
so,
true, but I think we all agree that during the crisis or pre-crisis, right, capital levels weren't adequate. So to say that they're higher isn't definitive in terms of are they too high? Are they still too low? Are they about right? Kind of what do you use to indicate this is the about right level of capital?
Well, the stress test, for one.
Okay.
You look at the stress tests and you throw a scenario that's equivalent or maybe even a little stronger than what happened during the global financial crisis, and you see, do these institutions have the wherewithal to remain reasonably well capitalized and really well capitalized enough to continue to have the confidence of the markets?
Right.
That's really the question. They have to be above certain minimums, and they do.
Yeah.
But not by some giant margin. It doesn't suggest that capital's too high. To me,
Right.
it suggests that it's just about right. And the stress tests are probably a great test for that.
Yeah. So I think you could see how it might be concerning for institutions that feel like they're caught in a bit of a circular logic, right? We contrive these stress tests, and then if they chin the bar on the stress test, then we believe that's right. That's exactly right, without going back and changing some of the underlying factors that go into the stress test. You can always say that, right? You can always say, as long as they chin the bar, that it's about right, no matter what the bar is. They want to go back and just look underneath the hood and say, gosh, are these assumptions still correct? The way that we have done these stress tests, is it the right way to do that, right? So maybe in a relative sense, yes, it's higher, the capital is higher than what the stress tests have indicated, but in an absolute sense, we're not asking the question, is this testing the right thing? And are we doing this test correctly? And does it include all the right variables? And I think that that's what they're looking for, is just further clarification on when we can expect that review comprehensively that the Fed has talked about for so long.
I think we've been doing that all along. We had a conference on the stress test last summer with experts, internal, external, academics, people from the banks. Yeah. We're doing that all the time. Everything we do with the stress tests is transparent, public, out for comment, things like that. Maybe not ex ante, but people can look back. Right. It's not like we haven't adjusted the stress tests.
Yeah.
The gentlewoman from Massachusetts, Mrs. Presley, is recognized for 5 minutes.
Thank you, Madam Chair, and I also want to thank the activists in the room who have been organizing for a more responsive Fed. I know, having been raised by a tenants' rights organizer, that activism can be a full-time job, and so we thank you for taking it on, and I thank the chairman for testifying before the committee today. Just as with Fed Now, the decisions you make do impact everyday working people. Your decisions impact how many jobs we have, who has what jobs, how much they're being paid, and who is most harmed when unemployment is high. Now, in the past, you've said we want prosperity to be widely shared. We need policies to make that happen. However, the Fed's approach has never successfully ensured enough well-paying jobs are available to everyone who wants to work, even for a small time. In a 1944 address, FDR called for a second Bill of Rights, which included the right to a useful and financially rewarding job. Justice Thurgood Marshall argued that the right to a job is secured by the 14th Amendment. And Dr. Martin Luther King called on the government to guarantee a job to all people who want to work and are able to work. Dr. King's legacy is often reduced to just one speech, and the March on Washington often mischaracterized. The March on Washington was actually the March on Washington for jobs and freedoms. It was a march for economic justice. And I take special claim to the fact that Dr. King and Coretta actually met in Boston. I represent Boston, and I don't think that she gets enough oxygen for the role that she played in the movement. And so after Dr. King's assassination, Coretta Scott King picked up the mantle, pushing the Fed to adopt a full employment mandate. and was actually standing behind President Carter as he signed the Humphrey-Hawkins Act into law, and that's the reason that you are here today. So in the interest of time, if you would indulge me and answer as succinctly as possible, yes or no, Mr. Chairman, given persistent concerns about inflation, do you believe the Federal Reserve can achieve full employment? And by full employment, I mean anyone who wants to work and can work will have a job available to them.
First, thank you for that history. I didn't know that. So that's our goal. That's what we're working to do at all times. And I think, you know, we're never going to say we've accomplished that goal, but we've certainly made some progress.
I'll take that as a yes. Could a federal jobs guarantee succeed where the Federal Reserve has not? Yes or no?
That's a hard one to answer. You mean by, I don't know.
Guaranteeing a job. That's the history that I was providing. That anyone who wants to work and is able to work.
To the fiscal
Okay.
authorities on that.
So Chairman Powell, by all indications, the U.S. economy has had output well below potential for 8 of the past 10 years, and for most of the decade prior. Is it true that most of that period has seen unemployment well above target, while we almost never seen inflation above target?
That is true.
Okay. So meanwhile, black unemployment remains double that of white unemployment. Now, the Fed began raising rates in 2016, even though inflation was still below target. And when rates go up, unemployment tends to as well. Did the Fed consider how raising rates would disproportionately impact those who were already struggling to secure employment, like communities of color, individuals who were formerly incarcerated, our immigrant neighbors?
So I would say that unemployment has continued to go down quite significantly since we began to raise rates at the end of 2016, actually the end of 15.
But again, did the Fed consider how raising rates would disproportionately impact those who were already struggling to secure employment?
I think our consideration was really that the right thing to do was to get monetary policy back toward a place where it reflected an economy that had recovered quite a bit for the benefit of all people, including low and moderate income people, including minorities.
There are a lot of people still recovering. But in the interest of time, given that there have been no signs of the economy overheating since then, and you're now cutting rates, is it possible you began cutting rates too soon?
I think history will judge that. We have to make the decisions in real time. We really have learned something since then, and that is that unemployment can be lower than most people thought without inflation.
So bearing that in mind, knowing what you know, would you still have supported raising the interest rates when the Fed did?
I did support it then, and you know, hindsight's 20/20. I think you have to judge those decisions on what we knew at the time.
Would more Americans have jobs today if the Fed had not increased rates over the past 3 years?
I don't know. We're at a 50-year low. It's a fair question.
Thank you.
Thank you.
I would like to thank Chairman Powell for his testimony today. Without objection, all members have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the chairman for his response. I ask you to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. Thank you all, and this hearing is adjourned.